Before we dive in, don't forget to like this video and subscribe to Now You Know for more fascinating content. Ever stared at a $20 bill, feeling its texture, noticing the intricate designs? Or perhaps you've glanced at a number in your banking app, a digital representation of your hard-earned savings, and wondered, deep down, why is this worth anything? What gives it its power and influence in our lives? After all, it's just paper, isn't it? Or digital numbers, fleeting and intangible on a screen. You certainly can't eat it, no matter how hungry you are. And it won't keep you warm on a cold night, offering little practical comfort. Unless you have a mountain of it, a veritable fortress of financial security, in which case, congratulations, you've likely transcended the everyday concerns about money's inherent value. So what gives it value in the first place? What transforms this paper or these digits into something so coveted and essential? Is it just a collective illusion, a shared belief that we've all bought into? The short answer, well, it's far more complicated than you might initially think. It's a multifaceted issue with layers upon layers of influence. That banknote nestled in your wallet, seemingly so powerful in its ability to acquire goods and services, has absolutely no real use if society collapses, if the foundations of our civilization crumble. But right now, in our functioning society, you can swap it for a delicious hot pizza, satisfying your cravings, or movie tickets, transporting you to another world for a few hours, or anything else you want, from the mundane to the extravagant within its monetary reach. Ultimately, it's all about collective faith, a shared understanding and trust in the system. We agree, as a society, that these tokens, whether physical or digital, have value and can be exchanged for goods and services. And that agreement, that unwavering belief, is what makes them so incredibly powerful in our daily lives. But money's value isn't simple. It's not just about faith. It's a tangled web of interconnected forces, a complex network that's constantly shifting and evolving. Government rules and regulations play a significant role, shaping the landscape of our financial systems. Economic forces like supply and demand, inflation, and interest rates exert a powerful influence on the value of our money. And let's not forget human psychology, our inherent biases and emotional responses to money, which can drive market trends and influence financial decisions. There's no single puppet master pulling all the strings, dictating the value of our currency. But there are plenty of powerful players, institutions, and individuals who wield considerable influence over the financial world. We'll get to them, exploring their roles and understanding their impact on the value of your money. The value of your money is constantly being shaped and molded by a complex interplay of factors, including governments and their policies, banks and their lending practices, investors and their market speculations, and even your own financial choices, the decisions you make every day about spending, saving, and investing. So, let's unravel this mystery together, piece by piece, exploring the intricate workings of the financial world. Because understanding it is key, it's absolutely essential for navigating the complexities of modern finance. To surviving, thriving, and achieving your financial goals in modern society. Buckle up, because we're about to embark on a fascinating journey into the heart of money. The world of money is far wilder, more unpredictable, and more influential than you might think. Get ready to explore its hidden depths. Let's talk about fiat money. It's a concept that underpins our modern financial systems, influencing everything from the price of groceries to global trade. Understanding it is key to navigating the complexities of today's economy. No, not the car, though the name coincidence is certainly memorable. Fiat means let it be done in Latin. It's a powerful phrase that hints at the authority behind this type of money. Fiat money is currency, declared legal tender by a government. This means that, by law, it must be accepted as a means of payment within that country. But it's not backed by gold, or silver, or any other physical commodity for that matter. This is a crucial distinction from older forms of currency. Its value comes from government decree, and crucially public trust. If people lose faith in the government or the currency itself, its value can plummet. For centuries, many currencies were tied to gold, a system known as the gold standard. You could, in theory, swap your paper for a set amount of shiny metal, providing a tangible backing for the currency. That system limited how much money governments could print, which kept things stable, but made it hard to respond to crises or grow the economy. Imagine funding a space program. Only if you had enough gold in the vault. Fiat money allows for more flexibility, but also requires careful management to maintain its value and prevent inflation. If money isn't backed by gold, what gives it value? Two words: supply and demand. Think of currency like any product. If there's too much of it and not enough people want it, its value drops. That's inflation. Your money buys less than it used to. It's why your grandpa's stories about buying a car for a nickel sound so wild. The balance between money supply and demand is what keeps your wallet's power in check. So, who's steering the ship? Enter central banks, like the US Federal Reserve, the European Central Bank, and the Bank of England. These institutions manage a nation's currency, money supply, and interest rates. Their decisions ripple through the economy, affecting the value of your cash. By injecting or withdrawing money from the system, they can encourage spending or cool things down to fight inflation. It's like a volume knob for the economy's cash flow. Central banks are the closest thing to puppet masters, but even they can't control everything. But it's not just central banks. The global economy and foreign exchange markets, forex, play a huge role. Currencies are traded 24/5 in massive volumes, driven by international trade and investment. When companies or investors buy across borders, they create demand for different currencies, shifting their values. Then there are speculators, people and institutions betting on currency movements to make a profit. Their actions can amplify swings, sometimes causing bubbles or crashes. The value of your money is constantly in motion, shaped by forces far beyond your control. It's a wild ride, and everyone's strapped in. Let's delve into some compelling real-world examples that highlight the intricate dynamics of currency value and economic stability. We'll explore instances where currencies have thrived and others where they've faced significant challenges. First, let's consider the US dollar. It stands as the world's primary reserve currency, a cornerstone of international finance. This status means it's widely held by central banks everywhere as a crucial component of their foreign exchange reserves. It's the currency they rely on for international transactions and to back their own monetary systems. This consistent global demand inherently props up the dollar's value, providing a buffer against economic headwinds. The demand creates a stable base. This support system helps maintain its strength, even when the US economy faces periods of uncertainty or stumbles. It's a testament to the dollar's entrenched position in the global financial system. Now let's contrast that with the situation in Zimbabwe. Specifically, we're looking at the economic turmoil the nation experienced in the late 2000s. Facing a severe economic disaster, characterized by plummeting production and widespread shortages, the government resorted to printing money non-stop in a desperate attempt to alleviate the crisis. Hyperinflation followed, a devastating consequence of unchecked monetary expansion. Prices didn't just rise, they doubled in days and then, unbelievably, in hours. The speed of inflation was dizzying. As a result, banknotes reached almost absurd denominations, reflecting the rapid devaluation of the currency. We're talking about banknotes with face values like 100 trillion Zimbabwean dollars. Yet despite their astronomical numbers, they were nearly worthless in terms of purchasing power. It's a stark lesson in monetary policy and its consequences, demonstrating that when trust in the government and responsible economic policy vanish, so too does a currency's value, leading to economic hardship for the population. A currency's worth can soar to great heights or collapse into near oblivion, fundamentally depending on how it's managed through sound economic policies, and crucially, on how much the public and the international community believe in its stability and future prospects. Ultimately, the difference between a strong, globally respected dollar and a Zimbabwean nightmare of hyperinflation and economic devastation, it boils down to trust, responsible policymaking, and fiscal restraint. These are the pillars upon which a stable and valuable currency is built. At the core, a currency's value is built on trust. Trust in the government, its institutions, and its central bank. Sound fiscal policy and an independent central bank inspire confidence. Rule of law, property rights, and political stability all help people feel safe using a currency. If these pillars weaken, so does faith in the money. In the end, money is only as strong as the trust we place in it. If you enjoyed this video, leave a like and subscribe to Now You Know for more.